let's focus on the management for today, which is Transportation Corporation of India, which came out with its Q2 results. They reported about a 13% of a revenue growth. Margins stood at 10.4%, while net profits saw about 22% growth. To give perspective on these numbers, we are joined in by Vineet Agarwal, the Managing Director of the company. Hello and welcome to the show, Mr. Agarwal.
Hi, how are you?
Yeah. Hi. So I want to first break down the Q2 numbers. You've reported about a 13% of a revenue growth. Margin stood at 10.4%. How was the quarter gone by for you? Was it in line with your expectations?
Yes. The second quarter of the year essentially happens in terms of the festival stocking that starts much earlier in August and September for companies like us. And that had happened, and we saw this time there was an increase about 5 to 10% versus last year in terms of the festival stocking. Certain industries and sectors have not done too well. Consumption is still a little low. Four-wheelers is still a little low. But we did see that some other areas like industrials and certain infrastructure-related, infrastructure-related projects, etc., have done reasonably well. The business that really shined out from us, shown for us, was the seaways business. Here we've seen a good growth in terms of both top line as well as bottom line. The international freight rates are quite high, which meant that some of the ships that were operating on the domestic sector actually moved to the international sector. So that created space for us to increase some prices on the domestic side. And we operate only on the domestic side, so we've seen a good growth in terms of the top line, as well as the cost structure remained almost same. So that helped in the bottom line. So yes, more or less in line with the expectations, slightly better than that.
Mr. Agarwal, you've mentioned that your seaways business remained on the stronger side, but if we look at the freight division, now margins did take a little bit of hit over here in the first half of this financial year, and even if we see the growth trends, the revenue growth trends, that remains moderated. Want to understand from H2 onwards, what's the outlook on this side of the business? Do you expect a recovery now?
Yes, the freight business is typically dependent a lot on what's happening in the overall market space, including a little bit more than the third of this business is less than truckload, not the full truckload business. The less than truckload business has been impacted a little bit because of the slow growth in the MSME segment. We know that credit offtake there has been also a little lesser, and MSMEs are struggling a little bit, and that has had an impact on growth in this space. However, we see that H2 is usually the better half of the year for all the businesses, including the freight business. Q3 is when MNCs are closing their books. Q4 is when Indian companies are closing their books. So I do expect this numbers in terms of the top line growth of about 6% should move closer to about 10, and we should the negative growth that we've seen on the bottom line should start to improve, and we should hit the positive numbers.
Okay, so that's a fair outlook for the freight division that you're giving for the next half onwards. But if you take the whole FY25 in picture, now if we go back and see your revenue growth had in FY22-23 about a 14 to 16% of growth levels that we'd seen, and margins more or less have remained in the 11 to 13% of range. So for the next year, that is FY25-26, what's your outlook in terms of guidance over here?
We've not worked on the guidance for that year yet. I mean, as a company, overall company, we have a guidance about 10 to 15% on the top line and and the similar for the bottom line. Actually, we do see a lot of trends that come up in Q3 and Q4, and that's where we do the budgeting along with the board and give our targets for the next year. There are some, like for example, last year there were trends around the elections. We knew things will be slow in Q1, and that will have a little bit of a spill down effect on the next few quarters. So like this, we are anticipating and waiting to see how things pan out, and then we can give you the guidance for FY26.
Right. Very neat set overall, Mr. Agarwal. What are the risks that you believe could come through or translate in H2, which are currently not getting fully recognized?
Well, certainly geopolitical risk is extremely high. I think we know that for a fact. And the direct implication of geopolitical risk is fuel prices. If crude prices go up, then fuel prices go up. And that hence would mean that we would have an impact domestically. Well, for almost all our contracts have a pass-through for fuel, but it does have a short-term impact initially. So that is a little bit of a negative, or rather it's a headwind that we see that is a possible headwind. Apart from that, faster growth in terms of consumption is something that we are seeing is not happening. I think interest rates still remain high, and that has impacted, let's say, growth in four-wheelers and including consumer durables, etc., in the broader market set. So if that starts reducing, we should see that the growth in the consumer durable sector start improving.
Okay, and if you have to see that overall, apart from the fuel cost you've mentioned about, what are the other kind of cost trends that we are seeing, be it the freight cost, the toll cost, what is your outlook on this? In the last 3 months, where have we seen this compared to the last quarter, Q1, and what is your expectation forward?
So we have several businesses. So the toll, etc., are a direct impact on our freight business, and toll has certainly gone up in the last 2 years substantially as part of a journey cost. In terms of our rail business, the impact is more on railway freight. So railway keeps increasing the freight rates, and that has an impact on cost structure broadly. On the seaways business, as I said, 25% of it is fuel. On the supply chain businesses, multiple factors, including cost of warehouse rentals, etc., that we have to take up. Broadly speaking, across all the segments, there's generally inflation, right? So we are seeing that whether it is people-related inflation or other cost-related inflation, and that we are trying to pass on as much as possible and preserve our margins. And we have been able to do that in the last 2 quarters. We hope to do that in the next 2 quarters as well.
Right. So this 15% kind of growth rate, largely you believe is absolutely doable. This 10% kind of margin with possible downsides of fuel prices going up, likely to happen Q4, right, Mr. Agarwal? Because you'll have seen the back of all the elections, especially at the state level, or most of them at least.
But the geopolitical risk is not something that any of us can see, so that can have an impact at any point in time on the fuel, and that has again a correlated inflationary impact, because not just the price of fuel goes up, but price of lubricant goes up, price of other related items related to fuel go up, and consequently there is more inflation. So I do not see when that would happen, but I do expect the second half of the year, as it stands today, to be much better.
Okay, thank you so much, Mr. Agarwal. It's been good chatting, great context.
Thank you.